Dramatic tariff increases have injected just a little bit of chaos into the economy, but what are the implications for commercial real estate and multi-family investments? Are they a safe refuge? Well, we will discuss more of what these new trade policies mean for the real estate market on this week's episode of The Gray Report, with a post from Berkadia laying out how recent events have impacted interest rate expectations, an article from BizNow calling out the market turmoil, pricing fears, and frozen deals unleashed by these new tariffs, and another article from Globe Street with actually a more optimistic take on CRE as potentially a safe harbor amid tariff turmoil. We'll talk about the differences between the multifamily market now and the multifamily market 5 years ago, when the latest economic upheaval was related to the pandemic. And then we'll cover some more positive signs from the apartment market as it heads towards this economic uncertainty with what could be the strongest fundamentals in years. So, if you're looking for the best news, research, and reports on the multifamily market, housing, and the economy, you're in the right place with the Gray Report. Let's get started. And we are back on the Gray Report. Joining me again is Addison Lubert, Senior Analyst at Gray Capital. It's glad to have you back. Spencer is out of the office again, but he will be joining us next week. And it's good to have you in here, and thanks for joining us.
It's great to be back. Thank you.
Thank you. Great. Well, let's just get started as quick as we can, and I'll get started with what's been happening in the economy. Spencer, what Spencer we usually do, we'll get some general impressions. And what was this big things that happened in the economy this past week? I don't know if you could give an example, one or two or one or three. What happened last week?
U.S. manufacturing is back. That's what I've been told.
Okay. All right. Good. You really hit the nail on the head there, and you put us in the right place. And you really let's focus on the positive here. We're bringing back a lot. But yes, tariffs were enacted by the Trump administration. Some very dramatic tariffs, probably the most dramatic tariffs in, well, I don't know, 100 years or almost. A very dramatic reordering of the world trade system. And Berkadia has a great article really kind of focusing on the interest rate implications of Tariff Liberation Day. This Liberation Day volatility, and well, we've seen the volatility in the stock market, and this kind of gets at a little bit the what might happen with the commercial real estate market, and specifically, we're talking about 10-year treasuries and federal funds rates. They give a general overview of the situation at hand. Stocks are down, interest rates are up, uncertainty reigns, there's little sign of change from the current circumstances, and a really dramatic reordering of the ways that people from different countries are trading with each other. And it seems here, to me, at least from my overview, and I'm trying to keep up as well as I can with what's happening and what the government is targeting. And I think they're targeting more goods than services, or at least their understanding of trade deficits is based on the trade of goods, in which we are in a deficit, rather than the trade of services, which we actually have a surplus of. So that means maybe we're going to see factories built. So let me get my rhetorical questions in order. Addison, will we see factories being built one after another in the United States, bringing, as you said, manufacturing back to United States, and replacing all the goods that were once manufactured in China and other countries? Secondly, will the United States generate so much revenue from tariffs that we can maybe even eliminate the income tax? Will other countries negotiate with the United States and with the Trump administration and work out a trade deal that is favorable to our own country? Those are our options. Perhaps, maybe there's other options. But of all these justifications held as reasons for the tariffs enacted on Liberation Day last week, I don't think they can all be true. There are some that kind of contradict each other or work at cross purposes. If we build all the factories, then we won't have the revenue. No one will be, if we're buying everything from the United States, then we won't have anyone buying from other countries and therefore paying the tariffs on it. If we're going to generate revenue from tariffs, then we can't build all the factories here because then we'd get less money from the tariffs, like I just said. But as a negotiating chip, you can oddly kind of hold both of these arguments true because what really matters is that the other side of the negotiation, whether it's China or Canada or whatever, that other side believes that you're committed to the tariffs. Because if there's a sign that the tariffs will go away by themselves, then why would these other countries give any concessions to the United States? So I don't necessarily think it's a matter of bluff or not. I just think that this is the I don't know, like the physics of this negotiation. The mechanics, I guess you could say, of how things are going to move when it comes to what they're talking about and how they're going to argue their position. That being said, going back to the Berkadia thing, worth noting here is that the labor market is still stronger. It's stronger than was expected given the latest jobs report. Labor market is strong enough, however, that the Federal Reserve may be a little bit more cautious about rate cuts. They don't want to set off inflation, and they don't want some kind of wage price spiral. And right now, the Fed's in a wait and see mode. They haven't really said that inflation or said that tariffs will set off inflation immediately. However, they have not foreclosed that possibility at all. And I think a lot of people are in a wait and see mode. Businesses are in a wait and see mode. Investors, wait and see. Importers, wait and see. Commercial real estate market and multifamily market, probably wait and see. You kind of name it. People are waiting and they're waiting. I don't know what they're waiting to see. Well, I have some guesses. And I'll let you respond here in just a second. I think that a lot of what people are waiting for, a lot of people are what they're waiting to see is some clear statement of goals that can explain a lot of the reasoning behind the current tariffs. Something that gives businesses a set of expectations and guidelines for the future, and maybe, just maybe, addresses some of the criticism of these tariffs. We'll be waiting, and that's what I'm looking to see, is something that can make things predictable. That's at the very least. Now, people have their own interpretations of what these tariffs might lead to. Is it feasible to build factories all year? And is that going to happen very quickly? I'm not the person that's going to be really arguing that very vociferously here. This is a commercial real estate podcast, but I do think that the waiting in and of itself is not that great. And I understand that withholding information, withholding some of your justification even, probably is an advantage if you're in a negotiating table, but you want to set expectations and you want to be forthright to the businesses so that they know how to operate. And they have ability to make investments and know that these investments are going to, that the future is going to be what I don't know. I just feel like some predictability is very helpful for investors at this moment.
No, I can't say I disagree. Something that's kind of eerie to me about this is kind of around the 5-year anniversary of a lot of the COVID shutdowns.
Yeah.
And just some of the economic fallout from that in its initial run up. And I feel, it seems like Trump has done a 30-day or 90-day pauses on these tariffs, or he's kind of done a start and stop a little bit with these from the get-go. And I'm almost getting the sense now that the 30-day, 60-day, 90-day periods that they're slapping on these tariffs, they really harken back to the approach from COVID of let's check back in 2 weeks and see where everything's at in terms of number of cases or where people are at. But for now, don't go outside or whatever. So it just feels like we're almost going back to that. And back in 2020 when Pence had come out and said that this virus would be gone by Memorial Day, and there were some of the instances there that at that moment I had considered that to be kind of what could be maybe his George W. Bush mission accomplished moment, and the Liberation Day could very well, no pun intended, trump that. But yeah, I think there's sort of a weird approach here going on back even to November, where there was the initial kind of stock run up after his election victory. And it seemed like there was people were bullish, but then there was this but he has kind of said some things that are going to cause some issues down the line, and we don't know if those policies are going to roll out or not. And then once he got inaugurated, it seemed like there was seemed like there's talk about that, but it's not going to happen. And then there were talks about it, and then they were implemented, and then they were pushed back. Now they're being implemented again. I don't. I guess I don't think any major industry. I should say don't think no major industry is coming to me for specific advice on what to do here. But wait and see is really all you can do.
Yeah.
And I think I don't think there's really going to be a systematic justification of it. Of we have these goals in mind. It sounds like from everything I've heard from the administration that they're going full steam ahead with this. That a lot of the things that they've the goals that they think they can accomplish, despite the fact that there's been plenty of criticism as to how those what impact those would have, or whether those goals can even be accomplished, they're still going to go ahead with them. So, I don't think there's going to be any guidelines other than just there's your tariffs, and you need to figure out specifically how that impacts your business and go about it. But it's a weird time. I would have thought that the initial kind of pushback and some of the responses,
much like the negotiators from other countries, they have to know that Trump is serious, and the markets generally didn't think that Trump was serious when he talked about tariffs early on, but it turns out he was serious, and I think people didn't really realize that until they were a week away, or even until really they were enacted. I think that's just particularly interesting. And we did have a little bit of a dress rehearsal for this like a month ago or 2 months ago, and when he put them on and took them off, and I wonder if that was for some that did not meet his needs, I guess, and so now we've got much more dramatic tariffs. This is going to mean this is a whole rebalancing of the economy, and I wonder, there's this idea you need to take him seriously, but not literally. But this is very literal. These numbers are literal. So I'm also wondering, though, because this is such a huge change. We're going from like 3 to 4% tariffs total, or something around those lines, cumulatively, to 10 times that amount. It just seems like that's going to be hard to pull off and hard to enforce, hard to set up all these rules, hard to get people to check all these goods coming in that are tariffed now and weren't tariffed before. Maybe there's going to be a manpower issue, although I'm sure they'll find people to hire. But that's the least of the worries. That it's just put a great deal of uncertainty into the economy. And that has also resulted in, you would think, at least I would think that would maybe drive down Federal Reserves or like 10-year treasuries. And Berkadia in their article does, point to an early dip in the 10-year treasury, but that dip has since jumped right back up. So very briefly, 10-year treasuries were below 4%, but now they have risen to above 4%. I believe, at the time that we're recording this, it could be 4.2, 4.3% for 10-year treasury yields. So that's what I
want to say it was at 4.3 today.
Yeah. Okay. So like 4.38. That's what the bond market is pricing in at this point. So it's very interesting, though, that there's not that demand for bonds that would drive those yields down. If a lot of people are buying bonds, right, the price or the yield for the bond goes down. Am I getting this right? Okay, so it must be that people aren't. And I think maybe part of the reason is also related to expectations for rate cuts. Now, it's very interesting. It says that traders hold on to projections for 4 rate cuts after jobs data. The jobs data was also stronger than expected. And I mentioned that wage price spiral, but I also think that different dynamics were at play, let's say, in January than now. In January, things were a lot more heated in the economy. But now I think the tariff pressure is also inflationary. So that might be part of the reason why people are factoring that tariff pressure as inflationary. Whereas before it was just like purely like the overheated economy, or at least just the lingering inflation pressures in January. It's a little bit of a swap, but I wonder if interest rates are going to start to come down as this market downturn increases and persists. Yesterday, now we're recording this on Wednesday. I haven't really glanced too much at the S&P, but I know that yesterday it went up and then it went down, and the markets. Investors desperately want and are clinging to, I think, signs of positive news. There was a perhaps erroneous report earlier in the week of markets reacting to a fake headline about Trump's willingness to negotiate tariffs, and I think that may have been coincidental. It was just a volatile market that coincided with someone announcing on Twitter that Trump was open to negotiating on tariffs. That being said, this is just messy, chaotic situation that we're in, and I wouldn't be surprised to see that translate into a lot of people looking for safe harbor, right, in 10-year treasuries. But all that being said, what this does illustrate, at least in the jobs report, and we'll see too in some apartment numbers later in this episode, we are in a strong position. Like before these tariffs were enacted, jobs were weakening slightly, but we were still well under what's considered well above what's considered full employment. And the same thing for the multifamily market. It was gradually getting better. The only issue then as now is that interest rates were stubbornly high. Challenges will still remain for the apartment market, just like they did in 2024 and 2023. However, man, this tariff just throws a great big question mark, and I think that the point of this Berkadia article is that you can't really rely on low interest rates. That's one key difference between now and the kind of early pandemic when, man, we had low interest rates, and a lot of things were different, and we'll talk about that in just a second. But for now, we'll talk about the reaction amongst the market participants in commercial real estate in a BizNow article entitled "Trump's Tariffs Unleash Market Turmoil, Fresh Pricing Fears, and Worry About Frozen Deals." What do you think? Addison, do you think that this is going to improve sales activity in the multifamily market? Or what do you think would be the big upshot to this kind of chaotic moment that we're facing right now? Let's just limit it to multifamily sales activity.
Well, to answer your first question, I'm going to give you 3 answers you don't want to hear, and that's yes, no, and maybe.
Yeah.
No, the pricing situation on multifamily assets moving forward, I think it's really going to come down to the kind of asset and also who your buyer pool is specifically, to just kind of what's their equity and what are they looking for. Mm-hmm. I think, when I was last on, I was kind of highlighting the kind of the resurgence of 70s built properties and, mm-hmm. and some of your older vintage and C-class properties, largely due to the fact that they have higher cap rates. Your institutional equity groups aren't going after them. And so there's a lot of value there for the people that go after those, that can execute those business plans, and overall that their structure can really work with that. You slap on these tariffs, you start messing with the prices of materials, yeah. and what they would be doing to do the rehabs. Now you're going to get into a situation where your project, I don't want to say double or tripled or whatever in cost. Yeah. I don't know the exact thing, but at that point, your costs are going to go up. And so, yeah, that's probably going to cause some headwinds, probably cause things to cool off there in the sense of, mm-hmm. I need to really figure out what this value add scope is going to look like, if I can even get these materials. Because I think it's either in this article or there's another one, and forgive me if I'm jumping ahead, where they just said, once these prices are inflated, it's really hard to get them to come down. So
yeah, that's a really good point.
There's going to be that part of the price discovery, mm-hmm. where I think real estate, specifically multifamily, where you can have a safe harbor is if you're a group that you're going into something, definitely if you're going into something all cash, mm-hmm. but your core assets where you're not going in with value add plans.
You don't
you're
have
not
to
going
fix
in
it up
with a massive scope.
Mm-hmm.
Maybe you're fixing flooring in a unit here or there, but
it's not a major part.
If you could just go to Home Depot and get the whatever you need, as opposed to doing bulk orders, you should be fine. So I think if you have all cash and you have that ready to go, I don't necessarily foresee an area where there's going to be a dramatic pause. But I think any groups where you still need to go raise the equity, or you just kind of need to confirm, I think a lot of people in the equity space are just going to be hesitant. And it's not a matter of not liking real estate. It's just everything's chaotic right now, and let's see where the dust settles. Let's see where things move. But as has been talked about through research reports by you and just covered on the show plenty of times, loan maturities are going to still be happening. And so in that back half of 25, you're still going to see the product come to the shelves, and that'll I think will be the biggest. What trades, what stuff do they keep off the market? Does it move forward anybody on certain decisions? Does it pull them back? I think that's just kind of how things are gonna unfortunately play out. I don't. The fundamentals are still really good. And I think anything that's going to have a component of your value add just with the initial news, I would say those are your ones where it's like, I don't know.
And I wonder if there's going to be a big bifurcation in maybe your like low B's and C class, the properties that are typically associated with a value add strategy, if those prices will really drop, and the price of A class core assets, ones you don't need to fix up, or not a lot, if those will remain relatively elevated as people really favor those. That will remain to be seen. I did want to share a couple of points in this article.
Sorry, something that's definitely speculation, because we don't really know we don't know how long these tariffs are going to take place. We don't know the full effect. Even if your small value add program is to just put smart thermostats in all the units and keyless entry, it's not to say there can't be a massive run up in those where even the smallest things you don't even implement because of how expensive it is. It's not to say that can't happen, but I would just tend to think that your larger scale value add, those are going to have your biggest headaches.
I agree. Just a couple quotes from this and a couple points from the article. One that I wanted to start off on is a developer that says, we were all kind of waiting for this day in hopes that it would bring that sense of relief or clarity. I want to emphasize that. And I don't think we got either of those items. What we have now is just a reaction, a global reaction to a real life-changing event. I would also emphasize real there, because before, again, in March and stuff, even after the initial tariffs were enacted, or was it February? Man, I don't know. But the first round of these tariffs were not necessarily cause for a market crash. And I'm not saying that the recent downturn in the stock market is a crash yet, but it's certainly much more dramatic than now. People are taking them seriously. People see this as real. I also want to note that even though you mentioned safe harbor, and we'll talk about this in just a second with this Globe Street article that says that CRE is a safe harbor. The BizNow article shows that the NARI index, which tracks publicly traded real estate owners, is down significantly. That's dropped along with the stock market. And I took a look at a couple of the big apartment REITs, Avalon Bay and Equity Residential. They also fell in value at the same time that the stock market did. This BizNow article rightly notes that the strain that these tariffs will put on the construction of new apartments, new buildings, new office buildings, whatever, that's going to be a big thing. That's going to make things longer and more. It will extend the construction time, and it will make things more expensive. And I'm glad that you noted it too. The renovation costs, they don't mention that explicitly in this, but like renovation, maintenance, if something breaks, is the part going to be made in the United States, or or is it going to be tariffed and make it so much more expensive to fix an HVAC unit or a thermostat or whatever you have? There's a lot of things that will come out in the wash, and totally agree with what you said. Once these prices are inflated, it's going to be hard for them to come down. And I'll also note, we've been through inflation before, and it was weird and depressing how inflation had this long tail where, okay, some things were inflated, and then long after, things like insurance, after the initial bump in inflation, well, then you're looking at much higher insurance prices as everything kind of filters in and gets calculated differently, and the effects ripple out to all different parts of the economy. It's like depressing how slow, and then how you're just turning over every new rock and you find higher prices wherever you turn.
Yeah, specifically on the operating expenses side, I think it was payroll that was probably the first to jump.
Yeah.
And then you had your run up in utilities.
Okay.
And then that's where the insurance hit. And
okay.
There was sort of I'm sure people were hoping as much as opposed to expecting, but none of those prices went down. They're still elevated.
Yeah.
It's not like hey, there's a blip where your payroll went up to $1,600 a unit. Now you can get it back down to $1,300.
Mm-hmm.
It's up there. And also something to kind of circle back to from 2 weeks ago when we were on.
Mm-hmm.
And I had mentioned how when interest rates were really low in 2020 and 2021, and also when we were talking about the apartment demand that's still been robust, but
mm-hmm.
had a small fall off then and then ramped up. Combine that with the cheap interest rates, you got a lot of development going on without anybody's help.
Yeah.
And then moving forward, as rates were going up, there's still people that could build. Costs were going up. So they were dealing with the inflation of all their materials for that.
Mm-hmm.
That's where TIFs and abatements started to come into play. Now, it's not, I shouldn't say started.
TIFs and abatements were, is that like government subsidies for apartment construction?
Tax structures, to make either to get
government incentives. Basically.
Right. Yeah. In order to get properties built, period, or just
mm-hmm.
properties built in certain areas that they're trying to revitalize or whatever. With these tariffs, we could reach a point where even the TIFs and abatements,
you can't make up.
Right.
Yeah.
It just really, because your expenses your cost to build all these is already heightened. They're going to stay heightened.
Mm-hmm.
You have those TIFs to hopefully help make things pencil. These tariffs are just going to make that even worse.
Yeah. Yeah. That's a really good point. I wonder, and I do think we talked about this 2 weeks ago. I wonder how this is going to affect existing projects, if that's going to extend timelines, or if all of that is kind of laid out and arranged, maybe like they've bought all the stuff and beforehand, and if apartment is half done, they can kind of relax because they've got the contracts for all of their lumber, maybe, and all of their labor and everything like that, and so they don't have to worry. Or if just the ripple effects and confusion is going to make it a little bit longer. We know what happened last time there was inflation. That totally extended the apartment construction time. However, that coincided with pandemic related supply chain disruptions, and so. But I would think that a complete reordering of the global trade system would equate to a supply chain disruption as well. Yeah. So it is a very weird rhyming history kind of with the disruption of the pandemic, but we'll have to nail down later this episode on the key differences. One of which is the pandemic. There's no pandemic this year. There was 5 years ago, if people forget. But yeah, we'll get into that in just a moment. However, let's take a little more positive note. Yeah.
Well, and sorry to speak on the kind of the wait and see approach. Mm-hmm. I can't speak to the development side in terms of how they do the purchasing, whether they have all that stuff ready to go. Never been exposed to that, so can't confirm or deny anything. But we're talking about the value add scope. One of the biggest pieces of advice that they give to anybody implementing a value add program is that you don't want to fully update and fully upgrade the entire. I mean, unless you're buying a 60s asset and trying to bring it up to modern finishes across the board and mm-hmm. completely transform it, that's a different thing. But you really don't want to upgrade all your units, get them all to finishes, because the next buyer you're essentially asking to kind of coupon clip on an asset that's 30, 40, 50 years old.
Yeah.
Where what I'm curious to see play out with these tariffs on some of these value adds is, does it cause people to, let's just say they wanted to do half of the property and they're only able to get a fourth done, or they were going to stagger their finish levels and then realized instead of doing 1/4 this, 1/4 this, 1/4 this, the cheapest and most plentiful of the finishes we can get is at that lower level. So we're just going to have to do that. How does that work on executing their business plan, but then also on the business plan moving forward for the next owner of before you could say, hey, these, we upgraded a fourth of these units. We've borne out the rent growth, the rent increases or the premiums on these. All you have left to do is kind of continue our scope of work and you can realize it yourself.
Yeah.
How does the pricing on that, I presume I shouldn't say how, I have an idea as to how the pricing would change on that. But now the next group is looking at it and saying, I'm not even sure if I can get the materials to do to finish off the rest of that project.
Yeah.
Not even sure what the costs are going to be to even justify the premiums.
Yeah.
Wondering where those assets start to trade, because that kind of goes in the wait and see approach of if you're on that other end and you're looking to do the value adds, you have to try and you can't really make any immediate decisions until you know where all of these are shaking out.
Yeah.
Because all of a sudden you're $15,000 a unit at a $200 premium. Who's to say it doesn't shoot up to $20,000 a unit, $25,000 a unit? And that's not because you decided you're going to do more work to the unit. Your cost jumped up.
Yep.
And then you find yourself in a situation where to make the project work, you have to get, a $500 premium, and the market's not going to bear that. So, kind of going in that wait and see approach, that's, I'd say, a pretty big sector that's going to be in that wait and see mode for the time being.
No, that's a really good point. I think that you did maybe mention something that could be interpreted as a positive for the multifamily investment market earlier, when and maybe this really turns down apartment supply and makes existing apartments more valuable, or it spreads the demand around to fewer apartments. So now we'll see higher occupancy. However, I think that there's a big question mark behind that too. But also, you're talking about waiting and seeing, and there are a lot of investors, I think, that are waiting and seeing, and there is an increase in debt financing, and a lot of these articles that talk about how people are using debt more. I'm also reading between the lines there, and maybe the implication is that we'll have lower interest from investors, lower equity financing. If you're taking on all this debt, maybe that means the investors are less interested, and investors are waiting and seeing. But that's just a question that I've got.
Yeah, I'd be curious to see how people that are current investors in stabilized projects in, say, like a Nashville or Atlanta or a Phoenix, Austin, what their immediate thoughts are on this and how they feel about the future of their projects, because those were the kind of markets where if you buy anything right now, and granted there's more supply that's being built and it's going to come online, your rent growth is either stagnant or in some cases negative, but there's that hope, and I can't say it's not valid, that in 10 years you'll still be fine, because the population growth in Austin is still going to go. And they feel bullish the same way as Nashville, Atlanta, Dallas, all of these markets. I'm curious how they feel with these, because you need to get your projects that are going on right now finished up. And as you and I have talked about, we don't know with these tariffs if that means they're going to be able to get finished up, if we're going to have a great financial crisis situation, if you have the one house in the on the plot of dirt and then the entire neighborhood is just never built, and you have that one house, almost like the Bluth model home in Arrested Development. But we have no idea if those are going to get finished or if they do. But if these tariffs are here and they're around for a while, any of that future development pipeline is likely going to be gone. And that all assumes too that the demand for apartments, demand for housing in general, remains as elevated as it is right now. So I'm wondering if any of those people feel, and I'm sure they felt optimistic about the future. Obviously, their immediate returns aren't going to be great. Presumably their rent growth projections aren't hitting, if they're feeling any better about the 5 to 7 year outlook of like, okay, well, no immediate development is going to be. It was already pretty slim, but it's not happening now.
Yeah.
I wonder that, and then kind of going back to our pricing expectations or where we think pricing can go on some of these assets, where I am really curious to see where the core assets trade. And it sounds like from a lot of the feedback that we get from brokers, be it through completions or just some debt situations or business plan things, it sounds like a lot of it will be May and into the back half of 2025, where those are going to hit the market.
What are those?
The newer properties or newer builds,
a wave
like,
of
2000s or newer. And I'm wondering with the tariffs and what we mentioned with the equity, if you find an asset where it's not going to get bid up by some group with a massive amount of 1031 money, and if it's not going to come from a group that can just go in on an unlevered basis and write an all cash check, does their equity basically come to them and say, do enough people's equity partners say, where we could have accepted a 15 IRR in order for us to move into real estate, for us to really move market and do anything other than have it parked in treasuries, we need a 20 IRR.
Yeah. Yeah.
If you get enough of those groups, all of a sudden do you get an even better price discount than what we're seeing? So that's a lot of those things are now kind of coming to mind.
Well, and
how's that gonna affect?
What's going to happen?
Yeah.
What would happen? You'd think that in the face of that lower demand, the prices would go down. And we're talking about waiting and seeing. I had this discussion in 2023 of like, how long can you wait? And we were using at that point loan maturities as a trigger that will force people to sell or make that decision. But we know what happened is they were able to extend and pretend and all that kind of stuff. But now the apartment market is very, very close to what it was like in 2023 right now. The conditions are fairly identical. I mean, along the edges, it may be different. So there's obviously the economy is much different, but they're not a whole lot better than they were in 2023. And will they be able to extend is my question. And I know a lot of people have asked that, but there is we saw in the stock market, we saw these investors were willing to believe or to not take the Trump administration seriously until the actual date of Liberation Day, and then when it was real, then the apartment market dropped. I wonder if things do get real for the multifamily industry, for the multifamily sales market, and what that would look like.
Well, something that I think is ironic about some of the industry's views, or I guess broader corporate America's views on how the Trump administration handles things, is it seems like one of the ways
too political. Watch it.
one of the ways in which he's praised is that he says he's going to do things and then he does them. And it's just wild to see this many people be like, oh, I didn't think he was actually going to do the tariffs. Just a lot of that of like, well,
it's what I said earlier. Take him seriously, not literally, but turns out it's a lot more close to literally.
Well, yeah, that, and also just like he has been president before.
Yeah.
And the things that he said he wanted to do in his first term, he either did or tried to do.
Yeah.
So it's just kind of wild to hear the amount of people like, well, I didn't think we'd get to this point. It's like, really?
Yeah, no, I agree. And moving on to an argument that I think is worth highlighting, if not just as a discussion point, is this idea that amidst the stock market turmoil, amidst all the turmoil that was set off last week, is commercial real estate or is multifamily a safe harbor in compared to that uncertainty, compared to that volatility? Will people start pouring in and buying real estate because at least things aren't going to swing wildly up and down? I'm not sure if that's completely the case. But I will say that that's an argument that we used early in the pandemic. I think it was perfectly valid that, we said, well, multifamily real estate is not subject to the kinds of wild swings in valuations like the stock market, because you're constrained by longer hold periods, and it's just naturally, whether it's because of that or for other reasons, it's just naturally a less volatile asset. It just doesn't jump around as much. However, as I mentioned before, the REITs, the NAREIT or the Avalon Bay and equity residential, equity communities.
Equity residential.
Okay. Both of those two largest apartment REITs, they dropped as well. So if that's a communication of these apartment investors that has any relation to the kind of private equity that we are involved in, like multifamily syndication and other things that aren't necessarily traded like stocks, but are still commercial real estate investments, if that is connected in any way, then there's a chance that commercial real estate investors are a little bit bummed, are not as excited to invest. And again, like I said, reading in between the lines of this discussion about how much more debt was used to finance some of these real estate projects in 2024, you can kind of see, well, is there momentum, a kind of negative momentum of declining investor interests that's building, and will that result in more waiting and seeing, or will there be a reason for prices to go down? Now, this article, again, is a little bit more optimistic. I've been very negative, and I promise I'm going to land on my feet here with a positive note for the apartment market. But I thought it was just really important to recognize the challenges that that the current economic situation represents, and the challenges that multifamily operators are going to face, multifamily investors and acquisitions analysts are going to face as they look for the best deals and try to project the best futures for potential investments without having rose-colored glasses and thinking, well, no, investors are actually going to pour in from the stock market because they think that CRE is a safe harbor. This article uses data from Lightbox's CRE activity index, showing that in February, CRE sales activity jumped for the second consecutive month. And it jumped relatively high, maybe a 10-ish, 12-ish point jump. And that was like a couple of times in a row that was showing real interest. So January, more. February, more. But this hasn't yet recorded the Liberation Day, which is when everyone, had that reaction. So we're still about a month out from knowing how CRE activity will be impacted, or will have been impacted by that Liberation Day. The other reason, just in addition to noting that argument is out there and there may be some validity to it, I do think that it's worth just looking at these differences between this current challenging, uncertain environment in 2025 and what things were like in 2020 when we were still saying the same thing about the stock market, and I think it was right. And I think that history bore us out and bore a lot of multifamily investors out, that those who bought during that the upheaval in maybe like the kind of bottom, temporary as it was, of the market in 2020 and 2021 maybe, they really saw some huge valuation growth, huge rent growth, huge income growth, and like that was a success story in a way that is probably different. I think one key difference between now and 5 years ago is that interest rates are way, way higher. They were under 1% in 2020, and they didn't hit 2% till February of 2022. Currently, the 10-year Treasury has been hovering around 4 to 5% since 2023. So that same period where it was between 1 and 2%, looking back from now, it's been 4 and 5% for just that long. So it's not as favorable of an interest rate environment. And as we said before, we just covered from Berkadia how interest rate projections are not exactly, they're not expecting the rates to go down. So that's one feature. And I think that may be the most significant feature because, man, nothing stoked the market like low interest rates. It wasn't necessarily the increased housing demand in and of itself. Now, there was huge rent growth, but the low interest rates people were clamoring on, I think that fueled this kind of ecstatic, irrational exuberance during that time. I remember in 2021 where thinking like, is there a limit to this? Like people, it seems like things are going too well, things are running too hot. And we did get a reminder in 2022. Yes, they were.
Well, I was going to say, and not to continue on with the Arrested Development quotes, but all I can think of when you did the, like, is there a limit to the narrator voice? Like, there is.
Turns out there was.
Yeah. No, I would definitely say that, yeah, interest rates were kind of the biggest, like, either don't head to the sidelines if you're still out there, and if you're on the sidelines, get off, because yeah, you can go make those home purchases. You can buy that apartment complex. Just created kind of a surge of opportunity where it's just like we haven't seen these before, and also just with the interest rates going down, plenty of people that were in that situation of, hey, we are the valuation that we're going to fetch with low interest rates is better. This is the time to sell if we want to get into that business. And that wasn't just real estate. There are plenty of other companies that face those challenges of, or it's never going to be a better time for us to buy in terms of cost of debt, but also anything we thought about selling, the cost of debt, our valuations were never going to be higher. So yeah,
totally. And another key difference I think is in 2020 we were approaching a period in which the home took on this renewed significance to people. They were working from home. There were the lockdowns, which people, stayed at home. Apartment size actually increased as a result, and maybe, but the home was a big deal for a lot of people. Home prices, of course, spiked up incredibly in that time. So that context back then, that doesn't really operate now. We may be seeing some lingering effects of the increased importance of the home as a result of the pandemic, but they were sharply felt in 2020 in a way that they're not felt right now. So it's a different interest rate situation. It's a different situation when it comes to the pandemic as a driver of housing demand, and there's a different supply and demand situation. I know that the supply wave is kind of receding, and apartment demand has some strong momentum, but that's relative to 2 years, maybe a little more, of really anemic rent growth, of a large supply wave, of demand that has taken a bumpy ride. It's now improving, but that hasn't been the case for the past 2 years. Whereas in 2020, there was very strong, stable apartment supply and apartment demand in the pre-pandemic years. There was not these swings, and at least the inherent conditions of the apartment market and the immediate past of 2021 was a lot more stable than now, where we're kind of still recovering from a overbalance, a surplus of apartment supply, lower rent growth. The expectations for 2025 likely are going to be, maybe a little bit below average rent growth, and that's not even factoring in the changed economic situation from the pandemic. So that's where we are when it comes to the apartment fundamentals. They're just vastly different than 2020, and there doesn't seem to be an easy path to the kind of investment bonanza that fell in the wake of 2020. That's probably not going to happen in 2025. However, I can see a path. It's just going to be a big challenge.
Well, another thing I would add to the difference between the pandemic to now, and it's really hard for me to take that back. It's not really hard. It's more so depressing to think back to 5 years ago when I was still in college and going through all of these events.
Yeah.
With 2020, you still had, like I mentioned back, there were plenty of state and city governments that were doing the let's revisit things in 2 weeks to see where the cases are at. They were doing the rolling based on the mask mandates if wherever locality it was had them. Going through the different kind of precautions and how they were going to go, and kind of about how they were monitoring the situation. But even as they had bits and pieces of, hey, this is a once in 100-year event, and there's things that we need to wait and see, there were also some concrete realities that changed for people within a day. I mean, I remember in college getting an alert that was like, hey, we're not going to have, it was almost like an extended, I don't want to say an extended spring break, but for 2 weeks, you're not going to come back.
Yeah, I remember that.
And then within 3 days, it was like, no, you're not coming back.
Yeah.
And then, granted, I was in off-campus housing, but at that point, they were like, oh, yeah, I mean, you can live in off-campus housing, and then it became like, you can either get your stuff moved out now, or there's going to be a 2-month period, and then you get your stuff moved out. So, not to say my experience was everybody's experience, but there were plenty of people that either found out instantly you're laid off because, depending on what service they were, their company took a massive revenue hit, or just the way that they do their job on a day-to-day basis was significantly changed in a way that it just wasn't going to be able to quickly adapt.
Yeah.
But there were plenty of people where it was like, starting tomorrow, you are working from home, and you're working from home for the indefinite future.
Yeah.
And plenty of people had to make living adjustments based on that reality.
And currently, aside from and I do want to acknowledge like the firings associated with Doge and government firings. That's a decent amount of people. But like compared to the pandemic, it's not like everyone's fired now or everyone has to work from home now. The lockdowns were a very dramatic thing for a large amount of the population. Like that was felt, and that was a big deal. But now we see tariffs. It's kind of an abstract thing. We haven't seen huge price increases now. We haven't really felt the effects other than in the stock market.
Well, and to that point with the tariff announcements, there's no immediate change for me or for us today that I can definitively point to and be like, we can't do a value add anymore.
Yeah.
I don't know what the prices are. I have a feeling they're going to go up. I think in all likelihood they're going to go up.
And that's why I think we discuss these things.
Right. And so, but there's no, with these tariffs, everybody is from like a wait and see thing. And I could be completely missing something, but I don't think with this tariff announcement and how things have been rolled out so far, I don't think there's an immediate like, no, this is society is definitively changed.
Yeah.
It could be for this period,
That's
or just the way you think about things.
I kind of facetiously said like a reordering of the global trade system, but because like I do think it's dramatic to say that. However, like that's being treated like this.
I don't exactly think it. I don't think that's overblown.
Yeah.
I mean, if some China and some other trading partners that didn't really have a relationship, like they kind of had the U.S. in common, if they start trading with each other to a point where they don't really need to continue the relationship with the United States, that could very well happen.
Yeah. I think that is true.
No, I don't.
Just as much as like the factories that are being built in the United States, you would think that some of those factories are being built in those countries if they're not trading with the United States anymore.
Well, yeah, and these aren't things that we're going to find out in 2 days. If these tariffs are around for a year, several years, I mean, for an extended period of time,
And how hard do you think it'll be to build those factories?
Oh, when all the raws, when the materials come from other countries,
can't be easier.
Probably pretty tough.
Yeah. So I wanted to foreground all these challenges, and because I think that is the most important and relevant factor in the CRE market and the economy right now is figuring out where things are going, whether it's interest rates, whether it is the length of how long of a construction time is it going to be, or bare bones, are people going to start bidding a lot less for value add deals? Like there's just a whole series of things that these tariffs will have an impact on in the commercial real estate commercial real estate market and the apartment market specifically. And we talked about operations, so it's just a whole big mess of things that are going to be involved here, but. That being said, kind of acknowledging that, I also want to point to some signs of strength in the apartment market and in the economy in general. I mentioned the jobs report was stronger than expected, and if you look back at it, the economy was doing relatively well before the tariffs were enacted, and there was some real, some decent stability. There was no imminent, inherent crisis in the making. And I remember saying this specifically earlier this year. There's nothing inside the economy in the same way like that the housing crisis of 2008, there's nothing that's like, oh, this is imminent. You better watch this. It's the corn futures are going to upend everything. Like
we had started the year, I think, with a single digit probability or percentage chance of a recession.
Yeah.
Now it's at 60.
Yeah. So that, what we're saying is if this is the cause, we're meeting it with pretty decent strength from an economic standpoint and from an apartment market standpoint. I think that along with the economy showing some real strength behind all of the mess that has been caused in the past week or month or two, the fundamentals of the economy were really great, aside from lingering inflation fears. I also think that the apartment market there's some optimistic signs. Last week I was highlighting some numbers from Apartment List, and these numbers were painting a little bit more of a negative light on apartments. They were showing slightly increasing vacancies and rent growth that was largely just the same as the year before. Now, I don't think that that's going to change materially, but there are signs of clear improvement shown in articles from RealPage, and then we'll just really briefly cover this similar report from Yardi Matrix that says about the same thing, in terms of actually the apartment market is improving. Demand is increasing. Supply is decreasing. Rent growth is expected to go up. Mm-hmm. And we're meeting this crisis with about as strong of an apartment market as we've had in several years. So that is that's the optimistic thing. And if you wanted to skip ahead and maybe you were skipping forward you could skip all the negative stuff and just focus on this right here, is there's some good news in the apartment market, and it is also worth mentioning. In the January to March quarter, this is the RealPage article. In the January to March quarter, the U.S. absorbed over 138 market rate apartment units, making the highest first quarter demand on record in the RealPage dataset, which goes back over 30 years. So again, to repeat this is the strongest quarter in 30 years in the apartment market when it comes to demand. That's amazing. And yes, we had a lot of supply, but that supply in this last quarter has actually gone down. Supply for the year was 576,000. That's the year ending in Q1 2025. For the year ending in Q4 2024, it was 589. So supply is going down, demand's going up. That's great. Demand in Q1 was 138,302, like we just noted. Supply was at 116,092. So here, let me scroll down to the graphic here. That probably illustrates it a little bit better. Supply was lower than demand. That's good for apartment operators. That means improvement. So there are signs on the whole that the national apartment market is coming into greater balance. Now, we've seen balance in the Midwest specifically for a long period of time. The Midwest, their annual rent growth is at 3.6 for the region. Northeast following a little bit lower at 3.3, but that's still great and still a lot more than the South, which is at negative 0.2, or the West, which is at positive 0.5%. Now, this is just the regional averages for those regions. Very strong rent growth in the Midwest. It's something that we will be talking about in a future report from the Gray Report, and something that we've really focused on and been talking about ad nauseum within Gray Capital discussions. Is how the Midwest has shown not only strong rent growth now, but just stability throughout the period of the past 5 years. While they were really building and perhaps overbuilding in the Sun Belt, in the Midwest, we just didn't see the amount of overbuilding, and that has resulted in more stable rent growth that is as close to the national or the historical average as you can get. And you can see in this graph too how the supply and demand difference from basically Q1 2022 to Q4 of 2024, there was more supply than there was demand. That was a negative, so that balance was negative, and it is only recently, maybe Q4 and Q1 of this year, where it's become positive, where we've actually started to make some progress when it comes to filling up these apartments and not making them more empty by building new ones. Another good data point is this. The regional representation among the market leaders for rent growth. So the apartment rent growth leaders for March 2025, and this is the year-over-year rent growth, are very well represented by Midwestern markets. Kansas City is at the top at 5% rent growth, followed closely by Chicago at 4.8. Then you got Pittsburgh, San Jose, but then Cincinnati at 3.9, Columbus at 3.7 rent growth, then Detroit, and we'll throw Milwaukee in there too. These are all in like the top 10 apartment rent growth leaders, very well represented amongst the Midwest, and I'm looking for something that's firmly in the South. San Jose, I'd say that's more of a Western market. And
no, that's definitely a Western market.
All right, good. Well, yeah. And I don't see a firmly. Now, is Richmond, that's in Virginia. It's arguably the Sun Belt, but I'm not sure completely.
I mean, you can make the argument it's the South based on the sense that Virginia was in the
like the Mason-Dixon, which come on.
But I don't. You go through your list of southern cities. I don't think Richmond really comes to mind for a lot of people. But
but if you scroll down to scroll down to markets with the deepest rent cuts, then you see a lot more of these clearly stereotypical Sunbelt markets, led by Austin at 6.4%. That's negative 6.4% rent growth. It's kind of no surprise there. And Phoenix is negative 4.2, then Denver 4%, Atlanta, Jacksonville, San Antonio, Salt Lake City, Dallas, Raleigh, Orlando, and Nashville. Nashville, negative 1.5%, so that's your kind of range there. You're going from negative 6.4 to negative 1.5. Not any rent growth.
So a lot of these markets on this part with the deepest rent cuts, these are all kind of the markets that I was mentioning earlier of. I'm curious to know where their current investors are and how they're feeling about the tariffs, in the sense that they're not going to have a whole lot of supply, if any, to compete with moving forward. Should these tariffs have the effect that we think that they're going to have, and should these tariffs stick around? Also,
that's a really good point. Are there going to be specific markets that feel the effects of these tariffs more strongly or more weakly? Will this make like the logistics and supply chains within America like more relevant when it comes to how cheap it is to build? Like that's going to be particularly interesting.
I mean, I want to say Indiana is one of the states that has like the highest amount of jobs in industries affected by these tariffs. So that's
really okay.
Cause some heartburn. Or very well could. But I'm more so curious to look at these markets where like what is the true effect on new deliveries and construction? Kind of as we alluded to earlier, do we see some of these apartment complexes get halfway built and they don't have the money?
Yeah.
Could very well happen.
Which maybe leads to like a weird, like if supply construction is paused or delayed, does that mean that demand has more time to catch up to the oversupply in the Sunbelt markets? Is that what you're saying?
I would think so. I mean, if you go on CoStar or whatever, you can see kind of projects that are planned and they just need to get shovels in the ground.
Maybe I'm not going to do
some of that supply that you thought you're going to have to compete with, you may very well not have to.
Yeah.
But also to touch on the supply here, because that truly is.
Yeah, let's scroll up to the supply.
And I know this argument has definitely been advocated for on this podcast and other real estate forums of it is supply and demand, not rent control or other measures that are going to push us forward on making housing more affordable.
Yeah.
If you take the largest markets in the Midwest, whether they lost population or gained population, none of them really had a massive run up in new supply.
Yeah.
And there wasn't, I shouldn't say I'm not mistaken, all those markets, the big markets in the Midwest, they never hit double digit numbers in terms of their percentage of inventory under construction.
Yeah. Yeah.
The largest markets in the Sun Belt, I don't believe Dallas did. Dallas got
because that's
close.
Huge.
Dallas got, I want to say, like 9% of their inventory under construction.
But at one point, all of them were at
I can't say
yearly.
All. There were some that I didn't, but a lot of your big markets there. Phoenix definitely did. Nashville did. Austin did.
Yeah,
you're seeing it play out.
Yeah, yeah, and just a reminder: Austin, Phoenix. Those are the two markets with the deepest rent cuts. I think that's there are things that you can take from this, and it may be certain regions are going to perform better. Certain regions are in a better position currently. And I hate to say that we'll have to wait and see, because I think that there's enough data that we're parsing through right now where you can at least make a choice to not pursue some things, or to pursue things at a lower price than you would before. There was a quote in one of the articles here where, like, oh yeah, well, of course there are some institutional investors that are looking for some opportunistic deals. I was like, all right, they're looking for their knight in shining armor, the kind of perfect deal. That's when I see dry powder slated for opportunistic deals, I'm like, well, they're waiting for the perfect deal that may not ever arrive. But they were saying that as a way to soften the blow that the average investor, the average CRE investor that's not institutional, is maybe less interested at this moment in time than others. And that was partly in the way of explaining why there is a little bit more debt financing, a little bit more funding that's coming from debt, whether it's preferred equity or private debt, or
I mean, I think it really depends on how you want to define your investor type. If you're looking at people they're really in the real estate space, and they're familiar and they know what they're getting into, and a lot of their other avenues are investing are kind of on their list, kind of below in priority of real estate. Mm-hmm. No, I don't think any of those people are. I don't think they're going away, and I don't think they're less interested. I think there's a little bit of doom and gloom in the sense that a lot of these value add deals that, if you're an investor or a company that specializes in value add, I wouldn't say there's less interest, but today's definitely a gut punch. Yeah. Or this week is definitely a gut punch, because you don't know what the future holds.
And I was saying this in 2025 is like, do you wonder if there's going to be a kind of race to sell before it gets even cheaper? So if there is any reason for a multifamily owner to sell, would it become a pervasive idea that oh man, people are fleeing for the exits, we might as well get our 20% price cut because a 30% price cut is just a week away? That's an open question that I've got, and the only thing that I have running on it is loan maturities.
I don't doubt that. I think it's going to be more so your properties where you're going to have to bring money to the table to do work on it. Your core plus deals, if you're in your core plus deals, where you're in markets where the fundamentals are strong. It's not to say that won't happen, mm-hmm. but if you don't have to put work into the property, your rents are still strong, and your financing is still in line, I can't really foresee a scenario where it's we really have to get rid of this. Unless there's a lot of unforeseen stuff that goes on in the markets that we just don't know. If those prices do fall, I would tend to think that it would come not from the property and from the seller side, but from the buyer side.
Yeah. It's you got 3 buyers and they're all 10% or more below your asking price.
Well, how many people move back in the sense that our equity is just, it's a period we don't really understand. Mm-hmm. We really don't want to be deploying cash right now unless we can get really outsized returns on an asset that it's a home run that we wouldn't have been able to get otherwise. So, I guess in a roundabout way, you could see some sellers do that, but it really comes down to what the equity. I would say for your core and core plus assets, mm-hmm. it'll more so be driven by where the equity is than where the sellers are. Yeah. If truly that many people that have that situation on equity, you could probably see some sellers come around to that reality. Mm-hmm. But if you still have some people that they can ride an all cash, they could do all cash deals, or they have equity that's kind of really bought in and know that this is kind of the time to pounce and they're not going to have to do a value add program. I can't really see a scenario where it's really going to, you got to stop it from bottoming out.
Yeah, that's good. So just getting into this Yardi Matrix report, very similar subtitle, I guess you could say, from compared to the RealPage report. Some optimism, some signs of strength as we enter into this uncertain period. Gateway market performance is solid. They say New York and Chicago lead the top 30 matrix metros in advertised rent growth. And among gateway metros, only San Francisco is below the national average in 1% average growth rate. So these larger cities seem to be coming back. Year over year, advertised rent growth has held to a narrow range last summer, but it fell 20 basis points, still a positive 1% year over year. That compares to, what was it in RealPage? Let's go back to RealPage's number was 1.1%. So very, very similar between Yardi Matrix and RealPage in their rent growth numbers. When it comes to markets, they have New York City as the top rent growth market with slightly over 5%, let's say 5.5% year over year rent growth for all asset classes. And then Chicago's number 2 at a little under 5%, and then followed by Kansas City, Columbus, Philadelphia, Indianapolis, Washington, D.C., Detroit, New Jersey, Baltimore, Twin Cities, and so on. There is no Sunbelt market in the top markets with above average rent growth as listed in this Yardi Matrix report. Now, there might be smaller markets there, but among these top markets, you don't see one that's south of the Mason-Dixon, as you would say.
No, it truly speaks to the resilience of the Midwest, and I think the opportunity that's at play moving forward.
Yeah.
As I mentioned, your biggest markets in the Midwest, regardless of whether they had population growth, at least at the MSA level, they're showing strong rent growth. Chicago MSA, granted its population decline is not what certain news outlets would have you to believe, but it did not increase in population, and yet it's leading the way. Or close to leading the way on rent growth.
Yeah, and month over month, I'm just pulling this up too right now. Month over month, Chicago leads in rent growth. Now, you don't see the 5% typically for month over month rent growth. You're closer to like 0.5 or maybe like 1% if you're lucky. And that's what Chicago's approaching, almost 1% rent growth. You'll follow that out. If you multiply that by 12, that's like 12%.
Well, and
but I don't think that's going to stay that way. It's just you get a little bit more volatility with these month over month numbers, and that may be part of the reason why Charlotte is a month over month rent growth leader. However, you could see these monthly numbers as like a forward looking sign of a market's recovery. So maybe Charlotte is poised for a recovery. Who knows?
Well, and going back to the kind of the Midwest resilience, your markets also in here of Columbus and Indianapolis that did add population growth dating back to 2010 and also from 2020. They're up there as well.
Yeah.
And I'm also really curious to see where those month over month numbers come out. And we're not in leasing season yet.
Yeah.
So these numbers could look even better.
Yeah. That's a very good point.
They should look even better.
Yeah. Let's see. That's a good point. As leasing season out, it will really prove, because the February and March is a little bit into leasing season. I think you're like getting into it, but February, it's a little shakier, and you don't know exactly where the numbers are going to fall. But I like this list here that shows the year-over-year rent growth, and alongside the job growth of a given market. So, for instance, Indianapolis has 3.1% year-over-year rent growth with a 2.1% forecast, and they're saying that their job growth, the 6-month moving average, is 1.2%, which I don't think they have the national average here, but that compares fairly well with others. New York City, however, does have like a 2% job growth, which is it's the highest of all the markets listed here, and it's notable that their completions aren't just as strong. New York City is like a little bit of an outlier market though, because of the rent control, and it's just so much of a different animal that it's hard for me to like factor it in the list of other markets.
But this also hammers home what I mentioned earlier about construction, the percentage of your inventory that's under construction.
Yeah.
Chicago's at 1.7%. Their 12-month completions as a percentage of its total stock. They're at 1.7%. Columbus is at 3.8%. Indianapolis 3.3%. So those appear to be, at least if I'm missing something, Twin Cities is at 4%. So it looks like your highest of the entire Midwest is at your 4% level. Nashville, Orlando, Raleigh, Atlanta, they are all at that 6%, and then getting up to that all the way up to the 8% level at Austin.
Yeah.
So they're still going to have that lingering effect, and there's still going to be some heartburn in terms of the rent growth projections not not looking great
and
for probably the rest of the year.
And that's important to note too, is the apartments with the highest supply, those are going to be the last apartments where the supply wave ends. So they're going to have the longest period of oversupply.
Yeah, so to sum that up, the best time to invest in apartments in the Midwest was yesterday.
Yeah.
The next best time is now.
Yeah.
And an even better time after that would be tomorrow.
Yeah. And especially if you are equipped with the knowledge and commentary and insights generated by the Gray Report every single week. Thank you so much for tuning in. And if you want additional insights every week, actually twice a week on Thursday morning and Sunday morning, you sign up for the free Gray Report newsletter on www.graycapitalllc.com/newsletter. That's a free newsletter. It will give you a lot of these reports just right in your inbox. You can click them, download them, read them, or you can just subscribe to the Gray Report podcast and also get the news report, so you have that freedom. You know, you want to read, you could read. You want me to talk to you, I could talk to you. Or you leave a comment on this YouTube, and then you can criticize me, and maybe I will read your comment here on the show, or at the very least, reply to you and say, yes, you're right. I was wrong there. Thank you for the correction. Or I'll get in a big flame war. I think that might be fun. I don't know. All right. Thanks for tuning in. We'll see you next week.